Welcome back. Well, it's still all about the MPC meeting. Let's talk to an economist and the CEO of the CFG Advisory, Mr. Tilewa Adebajo. Good morning, Mr. Adebajo. Good to have you in the studio after a very long time.
Good morning.
Well, just wondering what is in your mind concerning perhaps what the outcome of this MPC meeting would be. Now, it's the first meeting of the year. How would you assess policy making in the last months? And would you say policy decisions have actually achieved its desired results?
Well, first of all, I think it's good to know that the quorum has been formed for the MPC, which will help restore confidence to the financial markets and also to the business environment, because there were a lot of concerns that the MPC did not hold in January as it was supposed to. Having said that, I think it's important that we consider the facts and take a look at the macroeconomic environment in which we are currently operating. The key challenge is the fact that we're just coming out of recession. The economy only grew about 0.8% last year and year to date as a whole. And it's good to fact that the Nigerian economy at least is out of a recession. But that whole recovery is still very fragile. And it's important to see that this economic recovery growth plan is properly implemented to ensure that we can sustain the growth rates. As you know, Nigeria's population is growing about 3%, and 0.8% growth is not what is going to sustain this economy. And if you take a look at even the growth projections for this year, it's not up to 3%. So we need to be able to grow this economy at least 7 to 10% to be able to see some impact on the lives of the people, of Nigerians, and to be able to see the sort of desired growth that we require. But in spite or despite all these challenges, Nigeria is still the largest economy in Africa. And this is the backdrop in which the MPC is meeting. There are challenges on the fiscal side with the fiscal deficit and financing the debt. The amount of money the government is using from its revenue to service debt is going to a state that is unsustainable, and that needs to be addressed. But unfortunately, that is not really the purview of the MPC, but that challenge is there. So it's going to be interesting to see how the MPC focuses on the key areas, which is inflation management, and of course the issue of interest rates, to see if they're going to drop interest rates. That's really the what we're looking to see this session.
So for you, you think it's time for them to begin to ease?
Well, definitely. I think it's important that they drop rates significantly, not just a token drop of rates. And I'll tell you why. Most of the developed economies that are going through their own problems with recessions, their interest rates are like 2%, 3%. If we do not have interest rates at single digits, it's going to be very difficult for us to sustain this growth momentum. And let's be honest with ourselves, the Nigerian economy was in a coma in intensive care. Right now, the Nigerian economy is now out of a coma, but still in intensive care. So we need to take this economy into the recovery room and then, of course, discharge from hospital. That is when we see that sustainable growth. So if you're looking at a growth target of less than 3%, which is the same as the population growth this year, you need to create that stimulus. The stimulus is not coming from the government side because, as you can see, we're in April and the budget has still not been passed. So the sort of capital expenditure that the government was hoping to spend to be able to create the stimulus to grow the economy is not forthcoming, and is not, there are challenges to even the budget implementation with the revenue profile of the government so far, despite the fact that oil is still at 70%. So it is important that that the MPC should consider dropping rates to be able to create that stimulus. Now, it's also important to realize that the reason why inflation has been persistently high, I mean, there's clearly a downward trajectory on inflation over the last 2 quarters. There's no doubt about that. And I think that that downward trajectory will be sustained. So what the MPC, I would recommend the MPC is the problem of inflation, if you look closer, it has to do with food inflation. If you drill down the numbers of inflation, food inflation has been persistently high at about 19 to 20%. And it's not, there's a reason for that. And that is the price we're paying for the problem in Benue State, in Taraba State, and Adamawa State, which is traditionally the breadbasket of Nigeria, or the food basket of Nigeria. Because of the problems they're having with the herdsmen and the clashes, productivity is low over there, and the sort of supply we're seeing there, food stuff coming to the market from that area, has been definitely curtailed. So there are economic consequences to this herdsman clash. So I think what the central bank or the MPC should do is to be able to help us at least reduce the rates, because effectively nobody can borrow at 30%, which is what the banks are charging, right, and have something reasonable.
Right. The CBN governor has always, signaled that, okay, perhaps very soon there could be rate easing, but they are still monitoring and watching, looking at the economic variables. You did mention the inflation rate, of course, which seems to be coming down, but gradually. And you mentioned the food price, which remains high. And of course, that was what my former guest here mentioned, and says because of that food inflation, the MPC might not perhaps take that decision to ease rates at this time. They probably would want to, wait a while. And I remember sometime last year, Dr. Kingsley Moghalu, that's the former deputy governor who was on our show, that was late last week, last year, had explained that there is high interest rate because there is high inflation. And he says that our recurrent expenditure is what is driving inflation, and that makes it essential for the CBN to maintain tight monetary policy. So how would you react to this?
Well, I'll tend to disagree, because I think we understand that it was a cost-push inflation that we had. It wasn't a demand-driven inflation. It was quite clear that the issue with inflation had to do with the removal of the subsidies and the issue with the electricity pricing. I think it was quite clear what those issues were, because there is no purchasing power. That sort of inflation is actually quite beneficial.